I'm with Joe Mazumdar. He is editor of Exploration Insights. Joe, you were talking at MIF, which is a well-attended show here, that the seniors have been, how would you say, reorienting themselves to the investing market with all of their acquisitions and with their divestments. Can you tell me what the seniors are doing right now?
Well, what they've been doing is like last year we talked about the mega mergers, consolidation of very big companies trying to get bigger. And the reason for that to get bigger was to get noticed by generalist investors. And now they don't want only gold bugs investing in the Barricks and the Newmonts, but they want people that would invest in companies, normal companies, that issue dividends and that. So that what they're trying to do is create a business that's self-funding and issues stable dividends, but is focused on the gold sector. And they've been trying to do that. And some of what they've been trying to do is sort out their balance sheets by reducing debt, cleaning up their asset portfolio, so they're focusing in on certain jurisdictions and certain areas, and then basically divesting all the little ones that don't matter to them. And those divestments have created a bit of surge in the M&A market with mid-tier producers. And so that's what's basically been happening with the mega mergers, but I don't see any more mega mergers happening. Now what we're seeing is the next level trying to consolidate, to try and do the same thing, to try and get to a certain market cap, a certain capital profile to attract generalist investors.
What is that next step?
The next step is for the mid-tiers, and so the last bit of M&A we've seen since November has been a lot of mid-tier producers buying operating assets and sometimes low margin assets in low geopolitical risk jurisdictions that don't have much technical risk because they're already operating, but that add to their capital profile, increase their market cap, and then potentially with that would attract investors that are more generalists. Because that's really seems to be the game right now, is to get bigger to get noticed.
Where does that leave the juniors?
The juniors right now, the problem right now with some developers is that they have to build it to get noticed because there's very few development stories being bought. The exception would be Continental Gold that got bought out by Zijin Mining, and potentially Massawa, which Barrick divested off. But that was a good acquisition for Teranga Gold, a mid-tier producer, because it was really close to their active plant. For the juniors, it's, you know, they may be forced to build it. I'm talking a lot of M&A has happened, but there hasn't been a lot of premiums. So the value has to be added with the asset by the company to generate the value for the shareholder. So you still have to go to pick the good management teams that actually can advance a project.
There seems like there's just a lot of money moving around right now, but you're just kind of like, where is there going to be like the building of new mines? Where is there going to be like greenfield of new mines? Because we're talking about many shortfalls that are happening in all of these spaces.
Yeah, well, really with the majors, what they have to do is use their free cash flow to build their new mines. And if they want to introduce stable dividends, they have to introduce a lot more capital discipline with respect to building projects. You know, they can't build all the 10 billion projects that Barrick tried to build before and Newmont tried to build with the Pascua Lamas and that. Now they have to build smaller projects, but that could generate the kind of free cash flow that they need. So we're seeing a decline in reserves. Like in Newmont, it was almost like, I believe, about a 30% decline in reserves. But now I think what they want to do is stabilize that at a lower gold price at $1,200, $1,250. But those would be the ones that would generate a lot of free cash flow to pay their dividends, manage their debt, and to be a self-funding company where they don't have to return to the equity markets, because I'm not sure the equity markets are there for them anymore. Really what they have to focus in on self-funding and creating a stable business.
Junior markets, you've been also describing that there's been a change in the investing environment as well, too. It's not the way it used to be, but now there's like new types of financing that is opening up for them.
Oh yeah, I mean the financing's literally a basket right now, and in my presentation I show that in 2019 we're back to the lows of last decade with respect to financing junior companies less than $1.5 billion market cap. Even though we've seen financings over the last 6 to 9 months, in terms of the total money involved, it's not a lot. So We've seen royalty companies becoming brokerage houses in terms of financing companies. We've seen private equity come in terms of taking equity positions. So there's a lot more areas for people to go to with respect to financing. I mean, the biggest treasure trove for most Canadian companies with Canadian assets is flow-through shares. That has basically underpinned a lot of exploration in Canada when normally you wouldn't see any money.
Outside of the merger and acquisition story that we had in 2019, it was also the coming of Australians. You had an interesting note regarding the timing of what was happening down in Australia and why they were so strong in North America.
Well, I mean, Australia, basically, Australian gold producers had that perfect storm of, you know, a China struggling economy with, not struggling, but, you know, the growth slowing such that the iron ore, the alumina, the oil and gas, everything that Australia produces, which is a multiple, you know, it's a plethora of commodities, their demand was going down, but that weakened the Australian dollar, which raised the Australian dollar gold price. So the companies that did really well were the Australian producers, because now they were selling gold at $2,200, $2,300 Australian. And they weren't getting a lot of cost escalation pressures that they were before with everybody else building, because it was a commodity super cycle. I mean, the only thing that was moving was basically gold. And so they were investing, they made a lot of money, they had their share price go up, and then they were looking to grow. But the problem was in Australia, all the valuations were so high, it was hard for them to do anything accretively. And then with what was happening in the Pacific, they couldn't see a lot of growth in the Philippines or managing risk in other places, so they chose to go to the Americas. And so a lot of the acquisitions they were having were funded by the Australians, and they were cash, because they had to be cash because they were acquiring Canadian or North American listed assets. So they raised money in Australia, cash, to pay these guys like the Barracks or the Newmonts with Red Lake, cash for their assets, which is exactly what they wanted.
Lastly, looking forward right now, we've had a Christmas surprise. We had gold at an 8-year high that was happened right after the new year. So there's interest coming back into the space, people coming back to the space. Where is the value? Where do you think is going to be the best promise or the best places to look if in this sector?
Well, you know, when we saw gold go up at the end of May and get past 1,300, 1,350 on its way to about 1,570, most of the generalist investors were preferred gold. So most of the ETF funding was in the gold ETFs. That's where all the money went. It didn't go into the equity ETFs like the GDX or the GDXJ. That only turned around September. And still net for the year, it's down. So if you look at the price to net asset value valuations for a lot of these companies, they're below, well below the heyday of when gold price was higher, or even at these levels. So you've got seniors trading on an average of 1.2 PNAV, whereas before they used to trade at an average of 2. So, and then you got juniors, producers trading at like 0.6, 0.5. So there's a lot of room still left in equities with respect to them actually making money off an improved gold price environment. We haven't seen that big tick yet.
Thank you very much.
All right. Thank you, Michael.
All the best.